And that's what the Federal Reserve is in business for, is to protect banks.
The government shutdown is now officially the longest on record. The repo markets have started showing signs of stress. The Federal Reserve has announced plans to end quantitative tightening. Is all of this just a blip on the radar, or is it the start of a market-shaking credit crisis? Hello, and welcome to Milk Road Macro, the podcast that is hoping that now that the elections are over, everyone remembers that we are supposed to be in a bull market. I'm your host, John Gillen. Today is Wednesday, November 5th, and today we are joined by Michael Pento. Michael is the president and founder of Pento Portfolio Strategies, an RIA firm that is focused on wealth management and global macroeconomic research. He is the author of The Coming Bond Market Collapse and produces a podcast called The Midweek Reality Check. Michael is going to give all of us a macro reality check, so if that sounds good to you, make sure you like and subscribe. Share this episode with someone who needs to hear it. The Milk Road Macro newsletter is your shortcut to understanding how the big picture moves markets. It's delivered to your inbox twice a week. The link is below in the show notes. So make sure you click that link in the show notes to get subscribed there, get in on the alpha. And without further ado, welcome to Milk Road Macro. Michael Pento, how are you, sir?
I'm doing fine. Great to see you, John. Looking forward to a good show.
Yeah, me too, man. I'm excited to have you on and talk to you. I think you've been a big thought leader in macro for a long time, so I'm interested to get your thoughts today. I wanted to start with a framework that you have for thinking about markets and bubbles. A lot of people talk about bubbles, but I think in your work, your analysis, you've talked about a credit, a real estate, and a stock market bubble as three distinct things. Walk our audience through what are these three bubbles, how do we think about this, and what do people need to know about these things?
Well, you know, I started my career after working on the floor of New York Stock Exchange. I was invited on the Kudlow show, CNBC. So this is circa 2005. And they needed a buffoon or a straw man they can knock down who actually thought there was a housing bubble. And I was one of those in the vanguard, during that time. And that housing bubble proved to be correct. We had a gigantic, international housing bubble, and it brought down the entire financial system. And here I am again saying that we have a triumvirate of bubbles, as I'm fond of saying. It's not just housing. Yeah, housing is in another bubble. The home price to income ratio today is the highest it has ever been. Now, you might find some people who poo-poo that metric and they'll dance around it, but you can't skirt around the fact that the home prices are to the greatest extent in relation to incomes as they've ever been. And home ownership affordability is as low as it has ever been. But that's just one of the bubbles. And I just want to add to that we have 25% of all single family homes that are investor owned right now. That's a record high as well. Talk about a shadow inventory that can come onto the market if home prices start to roll over. And I'm quite sure that they are in about 50% of U.S. markets right now. And I think it's going to be a lot greater than that to come. But we have two other bubbles in addition to the housing bubble. We have the enormous credit bubble, record-setting credit bubble, and we have the stock market bubble, which is the most overvalued, most concentrated, and the most leveraged, or one of the most leveraged we've ever seen in history. So am I a buffoon or a clown? Well, maybe I don't know. Maybe some people might think I am. But I have a slideshow that I put together of data. It's like, I think this is just a few, maybe like 10 slides, 9 or 10 slides, that shows you why or how we engendered these bubbles that have never existed concurrently in history. Like we had the NASDAQ bubble in 2000, but there wasn't a real estate bubble or a credit bubble. And we had a housing bubble in 2007, but there wasn't a stock market bubble and there wasn't a credit bubble. And now today in 2025, we have all three existing at once. So let's just walk through these slides as quickly as we can, succinctly as we can. So this is reserves of depository institutions. And if you can tell from the beginning of time of 1913 and Woodrow Wilson as our president, reserves in the financial system were very, very low. They're minimal because we didn't have a financialized economy. And look what they are today. They're over $3 trillion. So that tells me that and by the way, reserves are it's money that banks use to make loans off of. So it's liquidity for banks. And you could see that how it's skyrocketed. This is unprecedented in history. If we go to the next slide, if you don't, or if you have a question, I'd be happy to.
Yeah, no, I had a couple questions about this. So, in your first answer, you talked about concentration in the stock market, valuations there being extended, and I showed your slide on the housing market, and you referenced that being similar to the levels we had in the housing crisis before. Recently, I think there's been some growing concerns we might be seeing another credit crisis. There's been a lot of activity again this week in the Fed repo markets, and I think that this slide gets to this issue of reserves and ample, abundant, scarce reserves for banks. What are you seeing or thinking about what we've seen in just the news this week on bank reserves, and the activity we've seen in the repo markets?
But you see dramatic rise from the global financial crisis all the way up to the peak of reserves, which was 2022. That engendered the bubble. But it's the rate of change which I am most concerned about as a money manager. So the fact that reserves were going down. Obviously, it started going down in 22, and now they've kind of flatlined, but they're heading back higher again. And this is emblematic of how over-financialized the system has become. We have such an overextension of leverage that any drop in reserves, even though they don't have to go back to where they were, zero in 2000 or 50 billion, whatever, and pre-GFC, they just have to fall on a rate of change basis, and that's going to cause stress in the credit markets. You see what happened also on this chart too. If you look what happened in 2019 when we had the repo crisis, where banks couldn't repo treasuries anywhere near where they were. There was double-digit interest rate to repo a treasury. Why? It's because the banks didn't trust each other. They'd be around once they give away their treasuries. So it's the rate of change that's most important, and that's why you see the Fed panicking now. If you look around ostensibly and you say, well, Mr. Powell, the CPI has been above your target, your 2% target, for 4.5 years. So above their target for 4.5 years. Why in the world are you debating as to whether you want to cut rates by 25 basis points or 50 basis points? That's the big debate now. You have Governor Miran who wants a series of 50 basis point rate cuts. But you've missed your target to the upside of inflation for 4.5 years. Financial conditions are relatively easy. Credit spreads are relatively very tight. The unemployment rate is very low, historically speaking. And we have these asset bubbles. Aren't you concerned that you've bankrupted the middle class of this country? Does that bother you at all? Does it bother anybody at the Federal Reserve that home ownership is unaffordable for most people in this nation? I mean, you want to know why you have a socialist mayor in New York City? The reason is because it's the level of prices has bankrupted most Americans who don't even have $1,000 of savings in the bank. People in the top 20% like me doing pretty good. Right? We have our houses are doing okay so far. Stock market's close to a record high, and we're feeling really good. And we are responsible for 40% of consumption. So the economy looks like it's okay, but it's a bifurcated economy. Somebody described it as an I-shaped economy, where you have
Adam Taggart.
Yeah, Adam Taggart, the brilliant Adam Taggart, an I-shaped economy. So you have the lower four quintiles going down, and there's just a little up above, floating above it, a little bit of especially the top 10%, 1%, wherever.
Yeah.
Who are keeping consumption going.
Yeah, so I think that there's a lot of wisdom and insight in that, and I think it leads well into this next slide you had in your deck on the federal funds rate. Talk to us about like the Federal Reserve in their last FOMC meeting in October lowered rates to 4%. What are you seeing in this change of the Fed funds rate? Is this a policy mistake? And just walk us through your thoughts on the Fed's policy here.
Well, it's a huge policy mistake, John. I mean, where's it written? I mean, when Moses came down from Mount Sinai, it was one of the things on the tablet said, "Thou shalt never have a recession or an increase in the unemployment rate." I mean, it's just ridiculous. We have run amok with power. This is all about power, by the way. This is about keeping those in power in control of the situation. those who control our money supply, those control our government. That's what they want. They want power. And the way you keep power is to keep, the population enthralled and bred in circuses. It's been going on since Roman times. So, how do you make the population happy? Just keep throwing free stuff at them. Free bread and distractions. In the Roman Empire, we had this Colosseum. Well, today we have a regime of totally fiat money. Back in Rome, we had debasement, where they just took the silver out of the denarii and just added base metals like brass, copper, and now we have the value, the purchasing power of the dollar, which is lost about 98% of its value since 1913. How is that for stable prices, John? Is that a good job?
Well, this chart of the M2 money supply it's now going up again kind of reflects that impact, right? Like the dollar's debasement is really a result of this huge explosion in the growth.
It's the inverse of this chart. Can you go back to the real Fed funds rate, please? In the regime of bread and circuses, which really began full throttle after the year 2000 when the NASDAQ bust, we've had, for the most part, of that period of time since 2000 to 2022, we had negative real interest rates. And what do you do if you're a consumer or a business and they say, well, I could borrow money and borrow for, say, 2 or 3% and buy a house that's going up 18% a year, 20% a year in value, and I can rent it out and pay all my expenses. What the calculation is, hey, borrow money, float corporate debt to zombie corporations. If you're a government, it's wonderful. Hey, let's leverage up the national debt. 123% of GDP, 725% of our revenue is what the national debt is right now. These are disastrous numbers, becoming an insolvent nation like a banana republic. But when you encourage people to take out loans, when the real Fed's fund, when the nominal rate is near zero and the real rate is -8, you could take money out and buy anything and make a ton of money. All right? You understand that process, correct?
Right.
So that's exactly what we've done here.
The financial conditions have gotten so loose that the cost of capital gets so low that it really incentivizes people to increase the amount of debt in the system, increase the amount of borrowing, increase the amount of risk, all these different things.
So the first chart shows you how the Fed created the money supply and the Fed's balance sheet. I'll show you another chart soon about the Fed's balance sheet. Printing money from nothing. I think that's ex nihilo. Printing money from nothing. And then you make the cost of it, you push it down in nominal terms close to zero and in real terms profoundly negative. And you create massive bubbles. We can go on to the next next slide too, please.
Yeah. So I wanted to ask a question about this, about the balance sheet, because a lot of people have been talking about quantitative tightening and the Fed rolling off their balance sheet. And I definitely want to hear your thoughts on this slide. But I think you've also pointed out that the Fed's balance sheet has been declining, but in the month of October of this year, it's actually started to go up. And I'd love to hear your thoughts on what's been the reason for that change and what that signal is, or what signal that's sending to the market. So
here's a graphic depiction of the Fed's maniacal ways. I think they're diabolical. They say that they do everything for the American people. Did any name the American person who voted to have their purchasing power destroyed or having their savings destroyed by a central bank? Nobody has ever done that. But you see what happened. This is mostly post global financial crisis. And then you see the COVID in 2020, where they just went vertical, printing, $4.5 trillion for absolutely an absolute total overreaction. And we went from $700 billion in 2007 to $9 trillion in base money supply. John, base money supply is also known as high-powered money because it's the building blocks of all bank loans. And in a fractional, debt-based monetary system, when you make a loan, you increase the money supply. And when you have all these reserves, you can blow up the money supply to kingdom come. It was exactly what we did. But now, and then we had a nice halcyon era of quantitative tightening, We took the reserves down to a little bit over from $9 trillion or a little bit over $6 trillion. And now we're heading back the other way. And it's very clear to me that since the reverse repo facility, and I don't think I have this chart in this presentation, but basically what the reverse repo facility is representation of banks' excess liquidity that they didn't need. And that was $2.5 trillion post-COVID. And it went all the way down to, $5 billion. So essentially zero. So the banks have now no excess liquidity or very little, and their reserves are now declining. So we're starting to see some cracks, obviously, right on cue. I have a model that's built to detect all this stuff anyway. So,
right. Well,
so right on cue.
Oh, sorry. Go ahead, please finish.
Right
your
on
thought, please.
cue. Right on cue. The Fed's like you're like in bewilderment land. You're listening like, wait a second, I can't afford a house. Eggs are through the roof. Insurance is through the roof. Taxes are through the roof. My home price is unaffordable. Stock market is a record high, and it's 4.5 years since they've been anywhere near to 2%. And this person is now head of the Federal Reserve, Jerome Powell, is saying, I need to lower interest rates. And you're like bewildered. Like, what are they talking about? What in the world are they talking about? Well, because they can't be honest with you and tell you. They can't go through this presentation because most people won't understand it anyway. But what the truth is that once bank liquidity runs dry, the money markets freeze, and there's no more commercial paper, corporate borrowing gets turned off, and banks' balance sheets turn upside down, and there's chaos in the financial system. And that's what the Federal Reserve is in business for, is to protect banks. In reality, they pretend, they feign interest in you, but they are there to protect the banking system. Now they could say, well, if the banking system fails, then it's going to hurt you. And that is correct. But that's an ancillary, casualty of war. It's to always keep the banking system as solvent and as healthy and as profitable as possible. And they've done it for so many decades now that they've ended up eviscerating the middle class. So it's every time we had a recession, every time we had a stock market decline, it was bank profits might decline, so let's throw some more money and print some more money and borrow more money, borrow, print, spend, blow up asset bubbles until you get to the point where any recession or deflation will quickly metastasize into a depression, because that's how outrageous prices have become and how leveraged the system has become.
Yeah. So I think that this is all very helpful context and perspective on all of this. I want to kind of shift now away from this triumvirate of bubbles. And, I think that this is something that it can be very confusing, especially for retail investors who don't understand sort of these macro systems. I want to pivot to something you talked about before, which is that your model, which follows this sort of deflationary, inflationary cycles. And I wonder if you could just tell our audience a little bit. I know you don't have like slides on this, but I think this would be really helpful for our audience to sort of hear how you think about this, because even though all of these different bubbles that we have, you're still deployed into the markets and capitalizing on this bull run. So I'd love to hear your thoughts on how you view that, like knowing that there's all these risks in this system and yet still being deployed into risk assets. Just walk us through how you think about that and how your model sort of helps you navigate these markets.
So, John, the fact that we have an artificial economy built on asset bubbles and debt, that's been true for decades. So am I a perma bear? And I sometimes I read the comments where people say, "Oh, he's been saying this for years." Well, listen, I'm long and I'm short. There are times when I'm net long the market, like I am now. I've been so since the second quarter of 2023, after being short in 2022. And there are times where I'm short, like I just mentioned, in 2022 and 2008 and 2019. So I try to look at, this is what I look at, the second derivative, or the rate of change of inflation in the context of growth. So I have 5 sectors of the economy, macroeconomically speaking, can be in. And they range from disinflation to hyperinflation. And what you want to avoid is sectors 1, which is deflation or sharp disinflation, and sector 5, which is stagflation or hyperinflation. That's when economic growth just contracts.
Not happening, right? Exactly.
And in sector 5, it'll contract in real terms. In sector 1, it'll contract in nominal and real terms. So that's where the danger is. So the model is on high alert for rapid, intense disinflations, or of course deflation, which would be a disaster beyond belief. And what the Fed is so panicked about happening and already taking precautionary panic measures to stop, which will, I think, eventually lead us into sector 5, which is a kind of a, stagflation on steroids or intractable inflation, which requires which is where your 60-40 portfolio just destroys yours, because the stock market may go up in nominal terms, but not all of it will, and the bond sleeve will get destroyed. So I will short bonds and be invested in base metals and precious metals and energy, things that will protect you from stagflation, while I make money on on the shorts. Conversely, if you're in sector 1 and you have deflation or rapid disinflation, you want to overweight your bonds, and you want to get out of your, energy and base metals, high beta plays, things of that nature.
Okay, that's very helpful. So just to kind of recap a little bit of that, the stagflation phase is sort of like the end of the cycle when there's runaway inflation, but not a lot of growth supporting it. And then the other thing you're talking about is when there's a lot of rapid disinflation, which is when dollars or bonds get way more valuable in the market and people are flying to safety. I would like you to tell us a little bit about what reflation is, because this is a different phase of the cycle. And I think if I understand your research correctly, I think this is where you think we are now. So reflation is not a word most investors hear often. What is reflation, and what does a reflationary phase of a cycle mean?
So in a second derivative, it could be the inflation has been rising at 1% and now it's rising at 3%. So it's a reflation. It could be that deflation was, we were falling by 5%, but now we're only falling by 3%. So it's a second derivative. Even though we're deflating, it's the second derivative from 5 to 3, minus 5 to minus 3. So that basically it means that the economy is healing in terms of price levels. Prices are accelerating at a faster rate. And you put that in the context of the economic growth too, and you come up with which sector, which one of those 5 sectors you would be in. So that's how I look at it.
Gotcha. Okay. So if we're in that kind of reflationary phase, right?
Yeah. By the way, I'm sorry. Yeah, you are correct. That's why I've been net long, because I saw economic growth correctly, that it would be accelerating at a faster pace, which was why we're long stock, and we saw the inflation was accelerating too, but it's a healthy kind of strike that. There is no healthy inflation. It's an inflation that's not going to lead to a collapse in equities. It's very destructive to the economy and to the middle class, but it's not yet manifested into a fall in stock prices. I'm convinced that it will. I mean, I've set you up, and that PowerPoint is available to people if they want to contact my firm through the website, the contact page. I'll send it to you for free, and it explains how we got here, what engendered the asset bubbles, and it goes into it's a truncated version of the credit bubble. Just give you some bullet points, and also talks about in graphic forms like here's total public and private companies, their total value in relation to GDP. It's just show you how not only we're at a record high, but it's so historically distorted from the mean, from the average of these metrics. So we're going to have a reconciliation of these prices, and it's going to be brutal. And it's going to happen either through that sector 1, which is what they really want to avoid, is a deflation and a recession or depression, or it's going to come from that sector 5 where you see that the long end, and this is where I think it's going to be first, the long end of the bond market is going to go into full revolt. So prices crash, yields spike. And that will engender the correction in the housing market, because, mortgages the Fed doesn't control mortgages. I laugh at people and say, well, the Fed's going to cut rates, so that's going to be good for the housing market. Well, okay, yeah. So historically speaking, when the Fed cuts rates, the 10-year note and LIBOR would come down, LIBOR rates would fall. But lately, have you noticed that when the Fed cuts interest rates, especially when they're doing it in an inflationary environment, in fact, we just got today, we don't have much data, but we just had the ISM services prices paid component, which was much higher than people expected. We have an inflation problem in this country. Cutting the Fed funds rate, the overnight interbank lending rate, when we have a massive inflation problem and an insolvency problem, I don't say massive, that's hyper. When we're heading towards a massive inflationary problem and we're heading towards insolvency, if we're not there already, that tells people, like, look, I am not going to give you my money, the government, going out 10, 20, 30 years, if you can't get inflation under control and you can't get your spending under control. Why would I do that? Why would I loan money to the government at 4% on a 10-year note when nominal GDP is at 6% and inflation is at 3%? It's just not, it's a risk reward ratio isn't there. And when we do have a recession, interest rates could rise too, or at least not fall like they did in past times, because deficits are going to be close to $6 trillion. So I don't see any value really in long duration bonds right now. Fed cut rates 4 times in 2024 by 100 basis points in total, and the long end of the bond market rose. The Fed's cut rates twice now, right? And the long end of the bond market is rising, which means mortgage rates are rising and corporate borrowing costs are rising and student loan and a certain auto loan debt are rising. They are not falling. So it's not a panacea or a salve for the economy like it used to be because of our insolvency and inflation problem that we just don't want to deal with.
Yeah. So I really appreciate you coming on the show, Michael, because I think you have like I said, a deep understanding of these 3 different ways that this bubble is forming and all of the risks and problems of the system. But then also you understand as an investor that you still need to kind of be deployed into the right parts of the market at the right time. I'm curious a couple things about this, but I think the first thing I'll say is there any specific signal that you're looking for? Obviously, your model is kind of what dictates your movements as an investor, but is there any specific signal that would go off for you to be like, okay, now is the time to pivot on this? Because I think where we are at this point right now, gold has pulled back, the S&P has pulled back, but some people are saying it should recover and keep going. Like, what is the signal for you to switch from reflationary to one of these other phases where you're going to go more risk off? Like, is there something specific you're watching for?
Well, like you said, I have a 20-point model that I created, back tested rigorously, just to tell me exactly when I need. See, viscerally, I feel I'm nervous. That's how I'm built. I'm like, wait a second, we are in a massive bubble. I need to just park my money in the bank. But wait a second, the Fed funds rate is being reduced down to 2% or somewhere around there, 2.5%, wherever they decide to stop. That's if we don't have a recession. So I'm gonna get lower and lower return on my money that's in the bank, and yet inflation keeps going higher and higher.
So we had to have Michael change venues briefly to get access to a power supply. But now that we're back, Michael, I think you were answering the question of what your model's specifically looking for to pivot from a risk-off allocation more towards a risk-on allocation, rather, more towards a defensive or risk-off allocation. What are some of the signals that you're watching for? What does your model look for?
So my model focuses on financial conditions and credit spreads. So I can really hone in on the second derivative of inflation in the context of growth. And I look at things like the copper gold ratio, and I look at various metrics. And it's a proprietary model, so I don't want to give away too much. But basically, I'm most concerned about a sharp disinflation or outright deflation, or the spike of long-term yields. And if either one of those things to happen, it would trigger a threshold of caution in my model, and I would, begin to pare down my longs and increase the shorts in the portfolio. That's exactly what I would do. To tell you that we're close to the point where I would get it move into sector 5, that would not be the case. So we're still pretty hanging strong in sector 4, which happens to be one of the best that you could ever be in, because it's reflation and it's accelerating growth. But to go back to sector 1 or go to sector 5, I've already started to take a short in long duration bonds. So again, we're not in 1 or 5, which is when you have to, divorce yourself of that 60-40 portfolio. But since I just don't see any value at all in long duration bonds, and given the fact that we just have no interest to actually tackle the inflation problem, we have in May of 26, you're going to get Jerome Powell is going to be out, and there's going to be some, what I've called an obsequious sycophant, as I like to say, who's just going to be a puppet of the administration, who's going to just cut interest rates, regardless of what, what is a real, listen, by the way, I always like to preface this by saying, I support Donald Trump. I voted for him twice. So let's get that out of the way. I am not a liberal or a Democrat. I'm a libertarian. But I voted for him because I thought he was the best bet. And I still believe the better of the two options that was available, two viable options. But he's a real estate person. What is a real estate, a real estate person wants low interest rates. He loves debt and he likes a lower dollar, and that he's avowed that, and that's exactly what he wants to get. And that's what and he's putting the right people in place, like Governor Moran, and whoever replaces Powell will do his bidding. Now, does that make me, does that mean that I watch CNN and not Fox, or does that make me, an anti-Trump? No, it's just I manage money for a living. So we have to live in reality. Can you say that you vote for the man, but you don't agree in everything that he does? You think he's a genius and a great business person for the most part, but he is not an Austrian economist. He's not. So I'm sure I'm sure at this point I've offended almost everybody.
Well, look, if you haven't offended anybody, yeah, sure. Look, everybody's entitled to their opinion. I don't think it's necessary to get political one way or the other, but I think what your point is that you kind of have to trade the market you have and deal with reality as it's coming at you. I'm glad we kind of got to this point, because I do want to ask your thoughts on this, because I think this is a really interesting shift that's going to happen. So you said earlier in your answer that we're in one of the best possible phases of the cycle, so to speak, for continued economic growth and, like, let's say, bullish momentum. That could extend. It could extend potentially into next year. We'll see. We don't know. But at some point next year, we'll have a new governor of the Federal Reserve, right? Or chairman of the board of the governors of the Federal Reserve, right? And so that means, that could bring a new policy path. So one of the things that Stephen Moran and Scott Bessent have talked about, the Secretary of Treasury have talked about, is reforms at the Federal Reserve. So I want to get your thoughts on this. The Fed kind of has this dual mandate, for whatever it's worth, if it's true or not, of like price stability and low unemployment. They've talked about a third mandate, which is moderate long-term interest rates, which kind of, to me, implies that whoever is the next chairman might start engaging in more active yield curve control practices. And so I want to get your thoughts on that, because I think that could radically shift a lot of things about what we think about as being givens in terms of macroeconomic policy. We didn't think QE would be a thing, and negative, like such deeply negative real interest rates, until they did that either. Like, won't they stop at nothing to basically keep running it hot and keep this fugazi going longer? Like, what are your thoughts on that?
Well, I mean, so why we have a dual mandate is beyond me. So it's not low unemployment, it's full employment. I guess that's the same thing, but stable prices in my world is zero inflation. But now stable prices is now defined as a 2% target, and as like I said, we've missed the target for 4.5 years. So maybe it's 3 is close enough to 2. That's the mandate. I guess that means. But there's actually here's why I hate the other part of the mandate, was full employment. What does employment have to do with inflation? Zero. If you look at the facts, the times when we have very high unemployment rate is when we have the worst problems with inflation. Think about the late 70s. Think about even what we had in post-COVID, very high unemployment, and we had very high inflation. So inflation is a monetary phenomenon. I did not come up with that idea. Okay. Milton Friedman might have come up with it before me, and there's many Austrian economists who came up with that idea as well. And I adhere to that. So the Powell never says, or anybody in the Fed never says, well, our balance sheet is too big and we print in too much money. They never say that. So these are labor market economists, and they're wedded to the Phillips curve. But you brought up a very important point. And you said, now our third mandate is to make sure that the long-term interest rates never rise. out of control. Well, how does that happen, John? How does that happen? They don't
I don't
control.
know.
They control the Fed funds rate. That's easier to. That's in the money markets. But how do they control the long term rate? Well, they have something called interest rate repression, and they would just, like Mario Draghi did in 2012, and say, I am going to buy every single bond issued by the pigs, Portugal, Ireland, Italy, Greece. I'm going to buy every single. Try me. It's a bazooka. It's going to be huge enough. Try me. Go ahead, short the bond market. I'm going to buy everything I can. And that worked in 2012 under Mario Draghi in the ECB, European Central Bank. And the reason why it worked is even though that they were deemed to be insolvent nations, they didn't have a problem with inflation back in 2012. Inflation was moderating, and it was not an issue. We have, for the first time in our country's history, we have both an insolvency and an inflation problem. So I think if the Fed were to assent to the idea, and this is not a guarantee, by the way, John, and I don't know the answer for sure, but if I'm right and we enter into some kind of like stagflationary on steroid scenario based upon our monetary and fiscal policies, and long-term rates do get out of control, and then the Fed steps in and says, we're like Japan did too, we are going to cap the long, 10-year note will never go above, say, 6%. Well, is that, so they're going to buy the 10-year note, but does that mean that they're going to buy, so let's say, just do a thought experiment. If the 10-year note goes to 6% and inflation's at 10, and inflation is rising further away from double digits, and the Fed's buying all this treasury paper at 6% and creating even more inflation by their very actions, does that mean that that municipal bond debt isn't going to, who's going to buy municipal bonds if they're not being bought too? Because I'm going to be getting, say I'm getting 7% on a muni bond in this scenario, but inflation's at 10. Well, why would I do that? And who's going to buy corporate debt at that level? Does the Fed then say, I'm going to buy all corporate debt and municipal bond debt too? I will buy every fixed income. You just send it to me and I'll buy it. So how high does the Fed's balance sheet go, and how low does the dollar go, and what happens to this country in a Zimbabwe-like reactionary function? So it's a real danger. In other words, when you can put a cap on a yield curve when you don't have what is it now? $38 trillion of debt, national debt, 38 trillion.
Yep. Yeah. Right.
And when you don't have $38 trillion in national debt, and your inflation is close to zero, and your debt to GDP is not 125%, it's more like 50% or 40% like it was in the 80s, then maybe you can get away with this innocuously. But I don't think the chances are very high you will not be able to be successful if they tried such an action, which I have no doubt in my mind they will do and fail.
Michael, I really appreciate you coming on the show today. Unfortunately, I've already kept you longer than I promised I would. But look, I really appreciate the insight on this. And what I want our audience to take away is that it's not totally necessary to understand every single detail of what Michael's talking about, because these are complex systems. He's been studying this his whole career. But this is a great opportunity to educate yourselves, to lean in here, and to try to avail yourself of all the information you can, not just what they tell you on CNBC. So, Michael, to that end, thanks for being here. Where can we send our audience to find more of you and your work online?
So if you go to pentoport, PORT.com, you could go to the contact page and ask me and my staff for a copy of that PowerPoint presentation. We'd be happy to give it to you for free. No obligations of any kind. If you wanted to listen to the podcast, which I put out every Wednesday, which is a compilation of the salient economic data, if there is any, because we don't have much, right? We just have ADP. By the way, I could just say ADP surprise to the upside today. It was like 40-something thousand. Now, that's good news, because it was supposed to be 33,000 jobs created. ADP, this is private automatic data processing. Now, I mean, now we're living in a world where 40,000 jobs is like, wow, we're doing great. But I'll give you my interpretation of the salient economic data, like the ISM services prices paid component. That's $50 a year. And if you want your money managed in an active manager, a long short strategist who's been doing this for 35 years in this business, it's $100,000 minimum. You have to be a U.S. citizen and qualified for a long short strategy. But I'll take care of you in bull markets and in bear markets, which in this kind of world, you better have someone who knows what they're doing and has a plan, not a salesperson.
Michael, thanks so much for being on Milk Road Macro. I really enjoyed this conversation a lot. I hope you did too. So yeah, thanks so much for being here, Michael.
Thank you.
Absolutely. And thank you to our audience for joining us. I hope you all learned something today as well. So until next time, stay educated, stay safe, stay bullish, and we will see you all on the next episode of Milk Road Macro. Thanks so much for being here, everyone. Bye. Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.